you looking to sharpen your budgeting skills? You're in the right place. Welcome to the Budget Couple Podcast, where we talk about life, family, and how to afford it. And now, the Budget Couple themselves, Nate and Danielle.
Welcome to the Budget Couple Podcast. I'm Nate.
And I'm Danielle.
And this week, we're going to be talking about our recent home refinance. We're going to go over our reasons for doing it, kind of the math involved, but not real heavy math, and then some updated goals and why we're doing what we're doing. Before we get into that, we just want to thank all those of you who have left nice reviews for us. We really appreciate it. And if you want to do so, you can go to your podcast player of choice and just leave a review. And also remember, if you have any questions for us, you can go on to budgetcouple.com, click on that contact form, and it'll go right to my inbox. We're going to be updating those and answering, should I say, a bunch of questions that have been coming in recently. So we'll be taking care of those in some very recent or soon to be recent episodes. So let's go into this home refinance.
Okay, so people might go into a refinance for a lot of different reasons, actually. Some of the main ones that you'll hear are getting down to a shorter payoff period. So maybe you're going from a 30-year to a 15-year. Another thing might be because interest rates are dropping like crazy and they're a lot lower than what they were when you originated the loan. So you might want to lower your interest rates. Some folks actually like to cash out on their mortgages. So during a refinance, you can take some money out on your house as well. And I don't think either one of us would ever recommend that as a way to get cash or to as a loan option.
No, it's a very expensive loan.
Yeah, but that is one thing that people do. You might also be looking to get rid of your PMI or private mortgage insurance. So if you bought your house with less than 20% down, you probably had PMI. And if you get to the point where you have 20% paid off on your house, then you can refinance and get rid of that PMI. So that's another reason. And there may be others out there, but those are probably some of the main ones.
Yeah, and we in particular are looking for a lower interest rate because interest rates have dropped drastically, and also a shorter payoff period. But I don't think the payoff period was quite as big of a concern for us. It's just that when we factor in you can get an even lower interest rate with a shorter payoff period, that's kind of where it starts getting more exciting, because you're going to be paying roughly 0.5% to 1% more for a 30-year mortgage versus a 15-year mortgage. So you're saving yourself a lot of money potentially, not only in paying off the house faster, but also saving a lot on interest.
And while we were always putting, and if you followed us, you know, we were always putting extra money on the house each month. But so we were already going to pay it off in sooner than 30 years. But I personally also like having this 15 years, like kind of written in stone, written in paper. It just feels nice. And it makes you know that no matter what, you're going to pay it off early. So there's that piece of it too. That's probably just kind of mental. Yeah.
And I would agree with that. Having that hard date that's in the feasible future as opposed to 30 years when it doesn't feel like it's going to happen ever. It's kind of a nice feeling. Let's go in and talk about our original loan versus our new loan, kind of some of the basic numbers there. Our original loan, it was a $350,000 house. We had $268,000 left on that, and we're 5 years into that loan, roughly. We've actually refinanced before. This is our second one, but we're going to just simplify the numbers a little bit here. Our current, or our old, should I say, interest rate on the old loan was 3.875%, which was phenomenal. Still is a really good rate, but we could get it lower, and we were paying a mortgage payment of roughly $1,800 a month. Now, our new loan is a fixed 15-year loan. It's $275,000. I'm going to explain why there's an increase of $7,000 or $8,000 there in a little bit, or I guess it's about $9,000. And then our new interest rate is 3.25. So our new mortgage payment is now $2,300, where we've increased our mortgage payment by $500 a month. And that's substantial, but there's reasons for doing so. So if we go through and run some numbers in some online calculators, putting our old mortgage in, putting our new mortgage in, our break-even point on where we actually start making money on the loan, as opposed to where we have to make up the closing cost, is about 4 years, which is a little longer than I think we would have liked. But we're not planning on moving in the next 4 years, so it doesn't matter. If you're planning on moving like tomorrow, don't do this because you're going to cost yourself more money. But if you're planning on staying in your house 4 years, 5 years, that's not a bad number. If the smaller that number is, the better. But we're going to be saving an interest around $50,000 when you run the full numbers. But we're going to go through another scenario and another way that we like to look at it that will make a little bit more sense, I think.
So let's compare numbers again a bit deeper. So if we took the $275,000 that we financed the loan for at our original interest rate, or the one we had before this refinance, and that was 3.875%, and we spread that over the 30 years, we would pay a total of $465,000. So instead of $275,000, you're paying $465,000 total for the life of that loan. Now, if you take the same amount, that $275K that we just refinanced, at the new interest rate of 3.25%, and then put it at 15 years, we pay a total of $348,000 for the life of the loan. So 465 minus 348, you get $117,000 in interest charges that we're actually saving over the course of that loan. So this is $117,000 basically from comparing if we had just stayed on course doing what we were doing before versus what we did refinance.
And that's kind of how we wanted to look at it, because we were on course to pay it off in 15 years no matter what. But that change in interest payments really adds up across the board, no matter which way you slice it. It adds up. And again, our payoff period to break even is about 4 years when we run those numbers. This time, refinancing did not go as smoothly as it did before. The last time we did it, it was so easy, wasn't it? Like, I don't remember having any problems with it.
Yeah, I mean, we kind of just understood the numbers. I think we had a really good loan officer that described things well. I think maybe the numbers were a little simpler last time as well. But yeah, it went fairly smooth. It was not quite the same this time.
No, our loan officer, nice guy, but just didn't explain things the way that was making sense to us, and wasn't really on top of everything the way we needed him to be. So one of the lessons that we really learned from this was to make sure you ask questions. I was on the phone with him probably 7-8 times over like a 2-week period, just because I had questions and I didn't know what was going on. I needed things explained. And then even prior to us closing on the loan, we closed on a Monday. I called him over the weekend because we didn't have all the paperwork we needed and things weren't making sense. We looked at our closing amounts and they said it was going to be roughly $3,000 to $4,000, and we saw almost $10,000. And though it's a big discrepancy, so we needed to figure out what was going on, and we needed him to sit there and explain it to us. And we kept asking questions until we finally understood what was going on, much to his begrudgment.
Yeah, he definitely, it was some situation where he didn't give us, he thought he had emailed us some things and he hadn't. So there was some amount of us just not having all the information. But there was also a piece of him not explaining all the numbers. And while both of us are decent at math, we just, it was a world we didn't live in every day, and we're not reading these papers every day. And so when it's just thrown at us and we're not expecting to see some of those numbers, it's kind of scary. So just to give you an indication here of what we went through and what we talked to him about, like Nate said, we were looking at much higher closing costs than what we were expecting. So we weren't understanding a couple things. We weren't understanding that he actually decreased the amount of the overall loan by a certain amount because he was crediting us essentially our old escrow. So that was a weird way that they gave us that escrow money. It just hadn't happened like that before. Another piece of it was that they also gave us a $1,000 credit, so that minused some off of there as well. You also prepay some of your new escrow as well as a full month of your actual mortgage payment. So you're prepaying it, so you almost get a free month of no mortgage.
You pay
strange.
for it, but you don't have to pay for it. It's not one that comes directly out of your bank account. It's one they kind of credit towards you, but you still pay the money no matter what.
And then on top of that, we also did pay $300 in points to lower our interest rate a little bit. And so there were multiple things there that added up. And in essence, the amount of our closing costs were about $3,000. And that's what ended up getting wrapped into our mortgage. But then there were other things there that were causing the actual loan amount to go up that we weren't seeing, and we weren't understanding where we were getting those credits. So it gets confusing. It really does. And if you don't review any of this stuff, if we hadn't looked at any of this, if we had just literally signed all the documents, we would have gone in to sign the paperwork in person, and they would have handed us $1,000 check, and we would have been like, yay, we got $1,000 just for refinancing our house. Not at all what happened. In essence, what happened was we paid $3,000 in closing costs, but you just don't see that when you're just glazing over or just signing things. So make sure you ask questions and you really understand these numbers. And just to back up for 1 second, that $1,000 check that we had was because the amount that we owed on our mortgage, by the time it was all said and done, was $274,000, but our loan amount was for $275,000. So they gave us $1,000 back to make up for that gap. Just wanted to make sure I covered that we didn't have $3,000. It's in our loan. It just wasn't covered by the payoff of the old loan. And that's why it just gets confusing. And if you look at it at face value, you think you're getting $1,000 check. It's your money you're getting back. So I think that's one of our big lessons learned in this whole experience. And this is our second time refinancing, but this was a different experience, and it probably is every time you do it. We actually went with the same company again, and it was still a very different experience. Yeah, it all matters who you work with and what type of mood they're in and whatever else is going on. It's just what it is. A couple other lessons that we learned in this was to make sure you shop around interest rates. Make sure you get what you want, because you can take an interest rate, go to a bank, ask them to match it or beat it, and they could or will, and kind of just keep going around the circle a few times. It's going to take some time to do, but it's very important that you do that. Our current company and our past company happened to have the lowest interest rate available, so that's who we went with. But we shopped around and even had other loan companies tell us that the rates that we were getting on our current one were really good. So that made me feel good and kind of matched with what we wanted. But make sure you take the time to shop around. Remember, if you're spending even a few hours on the phone talking to other people, you're potentially saving yourselves thousands or tens of thousands of dollars. So it's worth the time. Unless you make like a few $1,000s an hour, then it's not worth your time. And if you do, I can give you our address to send us a little bit. We have some ideas of how you can spend that money if you need to, but just make sure you take the time to do it, because it's your money and you're the one ultimately responsible for how it happens, what it does, all of that. One final lessons learned that was super annoying for us, and if you watch Dave Ramsey at all, it was probably just a stupid tax. Although it wasn't really our fault. No, we're totally blindsided by this. In the past, we've always had to do an appraisal to understand like what the value is of our current home, and that plays into certain numbers in your refinance. And so we knew that we would have to pay for an appraisal. They're usually somewhere around $400 or $500. Ours was $520. We weren't looking forward to it, but we knew that was just part of the process. What we didn't know was that sometimes it's optional. Sometimes the bank chooses to waive that. Actually, you don't have to do it. We had no idea that was the case. Our loan officer never told us that at all. They actually told us to go ahead and schedule it and everything. And so we were getting everything scheduled in line with the timeline for our actual refinance. And about 20 minutes after the appraiser came and left the house, we got a text message from our loan officer saying, hey, your appraisal was waived. You don't need to do it. So really frustrating for us that we just wasted that much money. And it's just one of those things that again, we really wish our loan officer had been more open with us and remembered to tell us that it was a possibility that it could be waived. We would have held off. Yeah. If I had just been my normal self and delayed for a day or two, we would have been fine. But I was trying to be on the ball because I'm off during the summer. So I was trying to do all this stuff before we went on vacation, took care of everything. And it wound up costing us $520. It's not the end of the world. It's super annoying, but it's what it is. And just make sure you ask questions, because that's one we didn't think to ask, and it cost us in the end. So I just wanted to remind everyone about our kind of thoughts, our theory, our opinions on the age-old discussion of whether to pay your house off early or whether to keep your 30-year loan and pay the minimum and put all that extra money, if you have it, into the stock market or into your retirement accounts. And this is a tough one. It's been a tough one for us off and on for a while. There's no right or easy answer, I don't think. It's not black and white. You'll have some folks on one side saying you should pay the minimum on your house and you should put everything else into the stock market or retirement accounts because you're going to be making a lot more percentage wise. You could be making 7 to 10% in the stock market, whereas your house interest rate is 3-4%. So it makes more sense to put that money elsewhere. Our side of things, and what we've heard with other folks as well, is that we like the idea of just having a paid off house as soon as possible. Of course, you are saving in interest. But we like the freedom of having that house totally paid off and not having that payment at all. So it opens up options for us that we wouldn't have if we had that mortgage hanging over our heads for 30 years.
Right. Because if in 15 years we don't have a $2,300 a month payment anymore, that opens a lot of doors to things that we can do in our monthly, daily lives that we don't want to do or can't do now because we have that large payment. So it opens up a whole bunch of doors for us that were previously closed, and we're totally cool keeping those doors closed while we're working towards this because we want to have the freedom to do things a little bit down the road.
Yeah, I mean, it allows you to potentially change your employment. Like if you want to retire early and do something totally different that maybe you're not going to be making as much money or something, it's okay. You have that option to do it because your house is paid off. Or if, God forbid, one of you were to pass away or something were to happen in your life, you don't have that mortgage hanging over your head anymore. You're free and clear in your house at least. So for us, we like to kind of strike a balance, but we really would like to pay the house off sooner than that 30 years that most people shoot for.
Yeah, so let's talk about our updated goals. We talk a lot about goals, having short, mid, and long-term goals. The house definitely fits into a long-term goal, and what we do beyond that fits into a long-term goal. So our goal for the house now is that we are on a 15-year mortgage, but we actually want to pay it off in 10 years. Now, we didn't put it on a 10-year mortgage because the interest rates are about the same, and we'd rather have a little wiggle room just in case things don't go as planned. We'd want to have that wiggle room. But our goal is to pay that off in 10 years. To do so is going to require us to put an extra $9,000 a year onto the house, which means during the school year, we're going to put roughly an extra $900 a month because my school year is 10 months long. So 9,000 divided by 10 is $900. So that's kind of our goal right now. And any extra money that we have left over after every month, we used to just put it all onto the house or all onto a trip or whatever we're doing at that month. Now we're going to figure out what we want to do with it. We're still playing with some games on there, trying to figure out what we want to do. We're either going to be investing it, we're going to pay the house off even quicker, or we're going to do something totally different that we haven't really thought of yet. So there's some things that we have to consider, and our goal here is to get that paid off in 10 years, which would be incredible. That would put our son in middle school, and we'd have a fully paid off house, which just, again, opens up a lot of doors for us.
Yep. And just to expand on that a little bit, we, like I was saying earlier, we're kind of striking a balance at this point. Instead of putting all extra money into the house, we've just decided on a goal. We've decided we want to have it paid off in 10 years. And so we calculated what we needed to put away each month on the house in order to get to that 10 years. And that was it. And so the rest of our extra money, we want to use it for something else. And that could be investing in the stock market outside of our retirement accounts. We haven't dove into that world yet. We need to understand a little bit more about the taxes involved with that. But it could also mean putting a little extra on retirement accounts, so some of the months it's probably going to mean saving for trips. But, essentially, we're striking that balance and we're saying we just want to make sure the house is paid off in 10 years. We're not going to go crazy with it.
And that's about it. So that was our summer in finances as far as getting the house taken care of. This whole process took roughly about a month and a half to go through. And I think if we would have waited another few weeks, we probably would have gotten even lower interest rate. but you never know with that stuff. There's always a chance they could go up. So 3.25 is near historic low levels, and we're pretty happy with what we have. So at the end of the day, we had some bumps and bruises, but we're happy and we have a plan, and that's all we're doing. But that's going to wrap it up for today's episode. If you have any questions for us, again, go to budgetcouple.com and click on that contact form, and we will get back in touch with you. Otherwise, have a fantastic day. Thanks so much for listening, and we'll talk to you later.
Bye, guys.
Thank you so much for listening to this episode of the Budget Couple Podcast with your hosts, Nate and Danielle. For more great content and to stay up to date, visit budgetcouple.com. Make sure to check out the next episode of the Budget Couple Podcast, where we'll talk more about life, family, and how to afford it. We'll catch you next time.